Good morning, traders, investors, and market watchers, and welcome back to Market Meridian. It's Friday, April 17th, 2026, and we're breaking down one of the most talked about calls on Wall Street right now. If you've been watching the US equity markets lately, you know the story. The S&P 500 has notched new all-time highs, surging past the 7,000 mark earlier this week, fueled by AI mania, resilient corporate earnings, and hopes for Federal Reserve rate cuts later this year. But as the saying goes, markets climb a wall of worry, and when the wall gets this high, even the biggest bulls start to look for cover. Today, we're diving into a newly released report from Goldman Sachs that's sending ripples across trading desks worldwide. Titled Hedging the Overbought Rally, the note from the bank's cross-asset trading team, led by Tom Shea, carries a stark warning: the current market rally has gone too far, too fast. Goldman isn't calling for a full-blown bear market just yet. Instead, they're urging investors to buy protection while it's still cheap, right now, before the next wave of volatility hits. The report outlines 6 concrete, cross-asset hedging trades, spanning equities, credit, rates, foreign exchange, and commodities, all designed to cap downside risk while keeping upside potential intact. And for some of these structures, the upside-to-downside ratio is staggering, as high as 1:3-to-1. In this 30-minute deep dive, we're going to break down every part of this call. We'll start with why Goldman thinks the market is vulnerable right now, then walk through each of their recommended trades step by step, explaining the logic, the structure, the risk-reward, and how you can use these ideas to protect your portfolio in today's frothy markets. Part 1, the setup, why Goldman says the market is overbought. First, let's set the stage. As of April 16th, the S&P 500 closed at a record high of 7,022 points. It's been a wild ride in 2025. The index hit a peak of 6,978 in early January, then plunged 9% to a low of 6,368 in March, as fears of a Fed policy mistake and a slowdown in tech earnings rattled investors. But just as quickly, the market bounced back, driven by strong earnings from the Magnificent Seven tech giants and a wave of inflows into AI-themed ETFs. This rapid rebound has left many metrics stretched thin. Goldman points out that the S&P 500's forward P/E ratio now sits above 22x, well above its 10-year average of 18x. Institutional investor positioning in U.S. equities is now at its highest level since late 2021. Just before the 2022 bear market, retail investors are piling into call options at a pace not seen since the meme stock craze of 2021, pushing implied volatility down to multi-month lows, making protection cheap, for now. But the calm in volatility markets is a trap, the bank warns. The rally has left the market vulnerable. Geopolitical escalation. Tensions in the Middle East and Eastern Europe have simmered for months, but markets have largely priced in a muddle-through outcome. Goldman's base case is that these conflicts don't spiral into a broader war, but the risk of a sudden escalation, say, an attack on energy infrastructure that sends oil prices spiking, is underpriced. In this scenario, risk assets would face a sharp, violent correction, as investors flee to safety. Scenario 2, a growth slowdown plus sticky inflation stagflation. Like the second, more persistent risk is what Goldman calls a policy headwind scenario. The market is currently pricing in 3 Fed rate cuts in 2025, starting in June. But if inflation remains stickier than expected, driven by shelter and services costs, the Fed could be forced to keep rates higher for longer, or even hike again. At the same time, economic growth is already showing signs of cooling, with consumer spending slowing and manufacturing activity contracting. The result, a period of weak growth and persistent inflation, which would pressure corporate margins and force a repricing of risk assets. Goldman's solution: instead of selling all your stocks and sitting in cash, which means missing out on any further upside, build asymmetric hedges. All 6 of their recommended trades are long premium structures, meaning your maximum loss is limited to the upfront cost of the option or spread, while the upside is multiples of that cost if the downside. Scenario plays out. Let's dive into the first, and most straightforward, trade, the equity hedge. Part 2, equity trade, S&P 500 put spread for a 13-to-1 risk-reward for equity investors. The simplest way to hedge against a correction is to buy put options on the S&P 500. But buying outright at the money puts is expensive, so Goldman is recommending a put spread strategy. Release its latest policy statement and economic projections at the bulk of S&P 500 Q1 earnings season, with 80% of index components reporting before the option expires. The May 8 U.S. non-farm payroll report, which will give investors the latest read on the labor market. These events are the most likely triggers for a market sell-off in the near term. If earnings miss expectations, or the Fed signals it's pushing rate cuts to the back half of the year, the market could quickly retest its March lows. Implied volatility is at multi-month lows after the March sell-off. The VIX, Wall Street's fear gauge, has fallen back to around 13, its lowest level since early 2024. This means options on the S&P 500 are cheaper than they've been in over a year. The put spread takes advantage of this low volatility environment to buy protection at a discount. The downside is still priced for perfection. Goldman notes that the market is currently pricing in a less than 10% chance of the S&P 500 retesting its March lows by early May. That means the 630 strike, which corresponds to SPY at $630, or the S&P 500 at 6,300, is deeply out of the money. But the spread still captures the full move to those levels, delivering a huge payout if it happens. The trade has a delta of minus 20%, meaning it will move about 20 cents for every $1 move in SPY. That means it's a low-cost way to hedge a portion of your portfolio without giving up too much of your upside. Part 3, credit trades, playing both investment grade and high. Yield markets moving beyond equities. Goldman sees opportunities in credit markets, where spreads have tightened to levels that leave little room for further compression. They're recommending two trades here, one long protection in investment-grade credit, and one short high-yield credit. Trade 2, buy protection on the CDX IG 46 index. First up, for investment-grade credit, Goldman is recommending buying protection on the CDX IG 46 index, the most liquid benchmark for U.S. investment-grade credit default swaps. Let's break this down. The CDX IG index is a basket of 125 investment-grade corporate bonds. Buying protection on the index means you receive a payout if the index's credit spread widens, i.e., if investors demand a higher yield to hold corporate bonds, because they're worried about credit risk. Why this trade makes sense: recent spread compression has left no room for error. The CDX IG index has tightened dramatically in 2025. After widening to 68 basis points at the end of March, spreads have now collapsed back to 54 basis points, near their post-2023 lows. Goldman argues that this move has been overdone, and spreads are due for a bounce higher. The new Series 46 is more exposed to tech risks. The latest roll of the CDX IG index, Series 46, includes a larger allocation to large-cap tech companies, with the tech sector now making up 12% of the index. This is significant because fades, or if funding costs for large tech firms rise, the CDX IG index is likely to widen sharply, making this protection trade profitable. The index is highly correlated to equity sell-offs in times of market stress. Investment-grade credit spreads tend to widen as investors price in higher risk premiums. The CDX IG index has a high beta to the S&P 500, meaning it's a very effective hedge against a broad market sell-off. And because it's so liquid, it's easy to trade in and out of, even in volatile markets. Trade 3, short the high-yield market with a HY100 basket for high-yield credit. Goldman is taking a more aggressive stance, they're recommending a trade that profits from a widening in high-yield spreads. The structure here is a basis trade, sell short a basket of high-yield bonds, the SUCH 100 index, a Goldman Sachs benchmark of U.S. high-yield corporates, worth $100 million. Simultaneously buy $91 million of U.S. Treasuries with the same duration as the high-yield bonds. The goal is to isolate the credit spread. You profit if high-yield spreads widen, regardless of what interest rates do. Why Goldman is bearish on high-yield? There are three red flags in the high-yield market right now. Persistent outflows are a warning sign. Over the past 6 months, high-yield bond funds have seen consistent outflows, making it the only major credit market segment with net selling pressure. This is a clear sign that investors are quietly exiting the space, even as spreads remain tight. Spreads are near historic lows. U.S. high-yield spreads are currently in the 5th percentile of their historical range, according to Goldman. That means they're tighter than they've been 95% of the time since 2007. At these levels, there's almost no compensation for default risk, making the sector extremely vulnerable to any economic slowdown. Technical conditions are extremely weak. Despite the rally in risk assets this year, high-yield bonds have underperformed dramatically. The asset class is facing headwinds from rising interest rates, refinancing risk for highly leveraged companies, and a slowdown in corporate activity. If the economy slows, high-yield spreads could widen by hundreds of basis points, delivering a huge payout to this trade. Part 4. Rates trade, front-end receiver spreads for a Fed pivot. Moving to interest rates, Goldman sees an opportunity to position for a potential Fed pivot later this year with front-end receiver spreads. First, let's clarify what a receiver spread is. In interest rate derivatives, a receiver swap gives you the right to receive a fixed interest rate and pay a floating rate. If interest rates fall, the floating rate you pay will decline, and the value of the receiver swap will rise. A receiver spread involves buying a receiver swap at one strike rate and selling another at a lower strike, capping your upside but lowering the upfront cost. The rationale for this trade, Goldman's call here, is based on a disconnect between the market's pricing and their view of Fed policy. The market is pricing in almost no cuts right now. Fed funds futures are pricing in just one 25 basis point rate cut in 2025, with the first cut not expected until November. That's a far cry from the 3 cuts that were priced in at the start of the year. Goldman argues that the pendulum has swung too far. The market is now pricing in a higher for longer scenario that leaves no room for the Fed to cut rates if the economy weakens. The Fed's hiking cycle is over, but cuts are coming. Goldman's base case is that the Fed will hold rates steady through the summer, but as the labor market cools and inflation continues to fall, they will be forced to cut rates by 75 basis points by the end of 2025. The market, they say, is underestimating the speed of this pivot. Front-end volatility is too low. Implied volatility on short-term interest rate options has fallen back to pre-conflict levels, making receiver spreads extremely cheap to buy. If the Fed signals a shift to a dovish stance, front-end rates will drop sharply, and these spreads will rally hard. Goldman recommends focusing on 1-year and 2-year receiver spreads. The longer-dated structures offer more time for the Fed pivot to play out, and they're less sensitive to near-term noise from inflation prints. Part 5. FX trade, short pound sterling to US dollar to play the energy shock in foreign exchange. Goldman's pick is to short the British pound against the US dollar via a binary put option on GBPUSD. A binary put option pays out a fixed amount, in this case, 10x the premium paid, if the underlying currency pair trades below the strike price at expiration, and nothing if it's above. The structure Goldman recommends is buy a pound sterling to US dollar binary put option expiring on December 18, 2025, with a strike price of 1.235. The upfront premium is 10% of the notional value, meaning the trade offers a 10-to-1 risk-reward ratio. Why Goldman is bearish on sterling? There are 3 key factors driving this call. The energy shock is not fully priced in. The pound is highly sensitive to energy prices, because the UK is a net importer of oil and natural gas. Back in 2022, the surge in natural gas prices sent pound sterling to US dollar tumbling by over 22%. Today, while energy prices have stabilized, the risk of a new spike remains high. Goldman argues that the pound has not fully priced in the risk of a renewed energy crisis, leaving it vulnerable to a sharp sell-off. The UK economy is fragile. The UK economy is teetering on the edge of recession. Youth unemployment is now close to 15%, and consumer spending is under pressure from high inflation and weak wage growth. The Bank of England is currently priced to hike rates twice this year to fight inflation, but further rate hikes would only worsen the economic slowdown. This stagflationary dynamic is toxic for the pound. Structural headwinds remain. The UK faces longer-term challenges too: its reliance on natural gas from Europe, its high industrial These structural issues leave the pound vulnerable to sudden shifts in investor sentiment, especially in a risk-off environment. Goldman notes that implied volatility in pound sterling to US dollar has fallen to levels not seen since before the 2022 energy crisis, making this binary option extremely cheap. The strike price of 1.235 is just 1.6% below current levels, but the binary structure offers a fixed payout if the pair hits that level, making it an efficient way to bet on a sterling sell-off. Part 6. Commodity trade, inferred, gold or oil hedges. While the original report excerpt cuts off before detailing the 5th and 6th trades, it's likely that Goldman's final recommendations are in commodities, a classic safe haven during periods of market stress. Common hedges include long gold, which tends to rally during geopolitical escalations and market sell-offs, long oil call spreads, to hedge against the risk of a supply disruption that sends crude prices soaring. Given the focus on energy shocks in the GBP trade, it's highly probable that Goldman is recommending an oil hedge here, likely a bullish call spread on Brent or WTI crude. The structure would be similar to the equity put spread: buy a call at a higher strike, sell a call at an even higher strike to reduce cost, capping upside but offering a large payout if oil prices spike. Part 7. Key takeaways and how to apply these trades. Now that we've walked through all of Goldman's recommendations, let's pull together the big picture. Goldman's message isn't sell everything. It's, the market is priced for perfection, and you need to buy protection while it's still cheap. All 6 of these trades are designed to be asymmetric hedges. You risk a small amount of capital to protect against a large downside move, without giving up all of your upside. For retail investors, you don't need to execute every one of these trades to protect your portfolio. The key takeaways you can apply are: don't fight the Fed's higher for longer stance blindly. The market's pricing of rate cuts is still fragile. The AI rally has left US equities overbought, so consider using cheap put spreads to hedge. High yield credit is vulnerable to a repricing, so avoid chasing yield at these tight spreads. Safe haven currencies and gold remain underpriced hedges against geopolitical risk. It's important to note that these are institutional trade ideas, and some of them require access to derivatives markets that may not be available to retail investors. But the logic behind them still applies. In a market this stretched, it pays to have a plan for when things go wrong. Closing that our deep dive into Goldman Sachs' urgent warning to hedge the overbought rally. The bank's message is clear: the party on Wall Street is in full swing, but the exit doors are getting crowded, and the fire extinguisher is still cheap. Whether you agree with their call or not, one thing is certain: in markets this frothy, it never hurts to have a plan B. Thank you for joining us on